Hey guys, it's Kaylee and welcome back to Hippie in a Suit, where every week I talk about sustainability because I dream of a world where financial markets serve the needs of society and not the other way around. Oh! First of all, hello to my new subscribers. It's so nice to have you following along and I am thrilled that you are here. Second, sorry that I took a couple weeks off from uploading. Spring this year has been like 90% rain, and the last 2 weekends when I usually film and upload, there was this random gorgeous sunny weather and I decided to take advantage. But don't worry, I have 3 videos teed up, so sustainability content is coming your way. Today, I am going to be talking about a subject that I have actually been working on for a couple of years now in my day job, and that I have become quite passionate about, and that is sustainable finance. I do have a business degree, so I kind of thought I had a basics around finance, but as soon as I started working on this topic, I realized it is just this extremely complex, massive subject. So what I thought I would try to do today to help you out is break down some of the basics of sustainable finance that I think are important for a base level understanding of the concept. As always, I create a blog post with links to my research, additional resources where you can learn more, and 1 or 2 organizations that you may choose to follow or support who work on this issue if you find it interesting. You can find that in the description box below. Before we dive in, I just want to say that I have come to believe that this is actually one of the most important sustainability topics that I've worked on over the course of my career, because as much as I hate it, we live in an overly capitalistic society. So where money goes determines a lot of what materializes. And currently the way markets are structured is just not aligned with sustainability priorities that matter to a lot of people. So I warn you that this is just such a massive space, and what I'm providing today is the very tip of the iceberg, but I hope it's helpful in giving you an overall understanding of what sustainable finance actually is. So without further ado, let's get going. Finance is the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. To simplify things, I'm going to focus primarily on investment today because I think this is where a lot of us think when we think of the term finance. Investment is the process of putting money into or purchasing an asset in hopes of it generating income or appreciation in value. So it could be putting money into a company or even purchasing something material that you'll hold on to and hopefully will gain value over time. Investment is ultimately about understanding and managing risk versus return. There is a principle in finance referred to as the risk-return trade-off, and it states that potential return rises with increased risk. In other words, where there are low levels of uncertainty, there will be likely lower levels of potential returns. And conversely, where there are high levels of uncertainty or risk, this will be associated with high potential returns. And the key word here is potential, as there are never any guarantees in investment, and so we're always talking about potential returns. Now, if you think about what this means in practice, let's just use an example. If you buy a government-issued bond, let's say a financial product, that may only pay 1% or 2% in return, but you can be pretty assured that you're going to get that 1 to 2% of the money you're putting in because it's from a government, so it's a relatively, large institution that you can trust. Now, if you put that money instead in your friend's startup company, that could either be a huge success or a huge failure. If it turns out to be the next Lyft or Uber, you may be a millionaire. But the reality is so many startups fail, and therefore you very likely could lose all your money. So what you see here is with the government bond, very low risk, but a low reward. And what you see with your friend's startup is a high risk, a high chance of failure, but potentially high reward in the event it's successful. I won't belabor this point too much, but I do think it is worth noting because this concept comes up constantly in all types of finance and also a lot in sustainable finance. So let's now move to sustainable investment, or SRI, socially responsible investment, as you'll sometimes hear it called. These are investments that not only seek to make financial return, but also take into account environmental, social, and governance factors, or the impact an investment will have on society. A crucial thing to remember is that sustainable investment is a blanket term that includes a wide range of investment strategies and approaches with differing degrees of rigor from a sustainability perspective. This is why the term can get a little bit confusing. Many things are labeled sustainable investing, even though the exact approaches can vary a lot. The European Sustainable and Responsible Investment Association breaks sustainable investment into 7 main categories. I'm going to go over each one of them, but I do want to note before I do that the order I state them in is going from the most assets under management globally to the least. So in other words, the very first strategy has the most money invested in it globally, and the last one has the least money invested in it. Now, why does this matter? Well, you'll see very quickly that the strategies are more rigorous on the sustainability front the further we get down the list. But unfortunately, they do not have as much money invested in them compared to the ones at the top of the list. So I just wanted to note that because I think it might seem like they're all equal when really different ones are employed more than others. So first we have exclusion, which is screening based on ethical considerations. An example here would be a portfolio screening out any companies that engage in selling arms or tobacco or oil and gas. Next, we have engagement, which is the acquisition of shares in a company with the intention of changing its behavior, policies, or practices. An example here is an investor buying into an oil and gas company as a shareholder and then pushing for more disclosure of emissions or the pursuit of a more diversified strategy, for example, including renewables. They would do that in shareholder meetings and in their capacity as an investor in the company. The third strategy is ESG Compliant Investment, and this integrates ESG factors into investment decision-making. So let me quickly explain what ESG factors are. The E is for environmental criteria, and this considers how a company performs as a steward of nature and resources. The S is for social criteria, and these examine how they manage and treat employees, suppliers, customers, and communities where they operate. And finally, you have the G, or governance, and this deals with the company structure, so leadership, executive pay, audits, internal controls, and stakeholder rights, for example. So again, this strategy takes these factors into consideration when making decisions, and an example of what this would be only investing in companies that meet certain thresholds of performance on one or more of those factors. That would be an ESG compliant investment. The next one is norms-based screening, and this is the exclusion of companies that aren't practicing globally established norms. So an example here would be perhaps an investor would eliminate companies from its portfolio that do not align to certain global agreements. Some agreements that would be the UN Declaration of Human Rights, or the ILO Conventions on Workers' Rights, the Paris Climate Accord, or the UN Global Compact. The next strategy is best in class, and this is when you select companies that are performing particularly well on relevant ESG issues, either in general or within an industry. Now, I just want to note that best in class is also used in non-sustainable investment, just the best performers in any industry, but here I'm specifically looking at sustainable investment. So here an investor might screen a large number of companies, for example, on the Dow Jones Sustainability Index, and choose the top performers on environmental and social factors, for example, gender or greenhouse gas emissions. They'd choose the top ones and they would invest in them. The next is sustainability themed investments, and these are investments in companies that pursue some sort of sustainable development objective. For example, creating a fund of specific sustainability themes such as women empowerment, renewable energy, education, etc., and choosing companies that work on or perform well on those areas. And finally, we have impact investment. And this one, again, is where there's the least amount of resources, but would be the most rigorous from a sustainability perspective. Now this takes a little bit of explanation, so I am going to use the GIN, which is the Global Impact Investment Network's definition, and they define impact investment as investments made with the intention of generating positive, measurable social and environmental impact alongside financial return. Impact investments can be made in both emerging and developed markets, and they target a range of returns from below market returns to market rates depending on the investor's strategic goals. A hallmark of impact investing is the commitment of the investor to measure and report the social and environmental performance and progress of the underlying investments, ensuring that they are transparent and accountable. I think that's pretty clear, and as you can see, this is largely seen as the most in-depth process because of that focus on measurement and reporting social and environmental performance. Many of these strategies on the list are based on metrics that are publicly or privately available, so they do require an extra step of analysis anyway. But impact investing treats the social and environmental performance in a similar way to how the broader industry manages and treats financial performance, i.e., carefully measuring it, reporting on it, and in some cases, even helping to enhance it. So now that you understand the big strategies, let's talk about why investors take sustainability approaches in the first place. There really are two answers to this question: risk and opportunity. Risk mitigation has been the primary motivation of using ESG criteria for quite some time. Investors can use ESG as a way to ensure that companies are adapting to changing market conditions and improving their performance. With more and more governments implementing sustainability policy, and sustainability policies also being good business in a lot of cases, like energy efficiency, which is a huge cost saver, it's increasingly important that companies are considering sustainability in order to remain viable financially. For example, many large funds have divested from coal, even though it is still one of the cheapest ways to produce electricity and is therefore profitable financially. But investors have seen how coal has been phased out in countries all over the world due to policy, and therefore mitigate their risk of losing their investments altogether just by avoiding the sector, or by investing in energy companies that have more holistic strategies that might include different types of energy, or that have credible transition plans to green energy. Another example here would be fast fashion. More and more consumers are concerned about working conditions or the environmental impacts of these big companies, and that could be a risk for their survival in the future. In other words, managing these social and environmental risks is increasingly more important to ensuring that the money invested makes the return that's expected. Now, the opportunity side, it's slightly different. Many investors see frameworks like the Sustainable Development Goals, as well as those changing customer sentiments and enhanced awareness, as the future of most industries. For them, it goes beyond just mitigating the risk and into investing in the business models of the future, in areas that may not be lucrative at the moment, but will be one day. In addition, clients who are investors are increasingly demanding that their money has a positive contribution, and therefore they want sustainable financial products. Financial institutions need to respond to this demand and build the capacity to ensure their clients that they have solutions that will meet their needs. So I hope now that you have a pretty good understanding of ESG and impact. But you might be asking yourself, well, what is the difference between the two? You've explained it, Kaylee, but it's not really clear why they're so different. They both involve environmental and social dimensions. For me, this is a crucial distinction to make. And the way I look at it is this. ESG is about how a company operates, whereas impact is about what a company is or does in the world. I'll use tobacco as an example. If you go to a tobacco company's website, you will undoubtedly see information about their sustainability plan and performance. These strategies usually include things like ensuring there are no human rights abuses in their supply chain, doing rural development in communities where tobacco is grown, and these are social issues. They will also talk about minimizing environmental footprint, such as water inputs, emissions created, or the packaging they use. And of course, these are environmental issues. And finally, they'll have a clear corporate structure, potentially a gender parity in the workforce initiative, transparency in reporting, all of which are governance issues. An investor could look at these dimensions and score that company high on an ESG ranking because they are considering all of those factors, and those factors are important. However, impact goes one step further, and it looks at what the company actually does, the impacts of that business on society at large. The reality is a tobacco company's products are highly addictive and have a range of negative health impacts. So even if they manage all of those ESG issues perfectly, there are still legitimate and serious concerns and questions about the company's impact on society. I do want to make it clear that I think ESG is very important. As a society, we are better off if all companies are considering these factors in their business. But for me and many others, ESG is just the first step. True impact is the goal. Now, it's also important to note that determining impact is extremely complex. Think about a renewable energy company such as a wind power producer. Generally, we would think of their impact on society as positive because they're creating carbon-free energy. However, producing a wind turbine requires large amounts of steel, and it also requires a lot of space in the form of land or water to be built. If the company is not considering ESG factors in its operation, like how the steel is produced, or how it's recycled when the turbine reaches the end of its useful life, or how you mitigate the impacts of the turbines on land and water ecosystems, this will just create other issues. So you can see how both the ESG and impact sides are important considerations. They're just slightly different from each other. Which leads me to my last point, which is actually more of a piece of advice and what I want to leave you with today. Always look very closely at where you are putting your money. And that could be money you have, or if you're part of a pension plan or any other place where money is being invested on your behalf. Even though something is called a sustainability fund or product, it does not necessarily mean that it has the rigor that may correspond to your needs and values as a person. For example, in many large sustainability funds that are available to retail investors like you and me, the major holdings within those funds will be things like tech companies. This is because tech companies have a relatively low environmental footprint compared to, for example, resource companies. However, we know that isn't the whole story. A company like Amazon often features heavily in sustainability funds, and we know that there are really serious concerns about their employee treatment and also the impact of a company like Amazon on consumerism overall. It's not simple by any means, but just make sure you are informed about what you're investing in. Just because something has a label doesn't necessarily mean it will meet your individual standard of sustainability. All right, let's summarize. Sustainable investment or socially responsible investment are investments that seek to not only make financial return, but also take into account environmental, social, and governance factors or the impact of an investment on society. A crucial thing to remember is that sustainable investment is a blanket term that includes a wide range of investment strategies and approaches. The 7 main approaches are exclusion, which is screening based on ethical considerations; engagement, which is the acquisition of shares in a company with the intention of changing its behavior, policies, or practices; ESG Compliant Investment, which integrates ESG factors or environmental, social, and governance factors into investment decision-making; norms-based screening, which is the exclusion of companies that aren't practicing globally established norms; best in class, which is selecting companies that are performing particularly well on a relevant ESG issue, either in general or within a specific industry; sustainability-themed investments, which are investments in companies that pursue some sort of sustainable development objective, for example, a fund around a specific sustainability theme; and finally, impact investment. Impact investment are investments made with the intention of generating positive, measurable, social and environmental impact alongside financial return. Impact investments are made in both emerging and already developed markets. A key dimension of an impact investment is that it measures and reports social and environmental performance, which makes it more transparent and increases accountability. Sustainable investing is a growing space, and investors are interested in sustainability approaches for two reasons. One is risk, and one is opportunity. Mitigating risk associated with policy or changing consumer sentiments allows investors to protect their investments in a changing world that's becoming more sustainability aligned. On the opportunity side, investors see things like the Sustainable Development Goals as painting a picture of the future of markets and are investing in companies aligned with these goals in order to be future-proofed. In addition, more clients are asking their investors to make sure their money is having a positive contribution, and it is in their best interest to have products that align with this. The difference between ESG and impact is really a question of how and what. ESG is how a company operates, and impact is what a company is or does in the world. Both dimensions of sustainable finance are incredibly important. Always look closely at where you are putting your money, because while regulation is developing to create more standardization around what can be labeled sustainable, at the moment it is a bit of a mixed bag and you never know what standards it meets up to. Just because something has a label doesn't mean it will meet your individual standard of sustainability, so look closely. And that's sustainable finance. And that's it. That's all I've got for you today. Thank you so much for watching. I really hope you gleaned something from this video. I think this whole topic of sustainable finance is so incredibly important. And as I mentioned, I've become very passionate about it. As always, I create a blog post that you can find in the description box below. That includes links to all my research, resources where you can continue to learn more, and one or two organizations who work on the issue in case you want to support them or follow their work. Thank you so much for being here. If you learned something new, give this video a like. It helps me a ton. I'm still a new channel, but I'm showing up more and more in the search, and that's super helpful, and it's because of you guys giving the videos likes and watching them all the way through. So thank you very much. And if you're not already, please do subscribe. That also helps a ton. Thanks again. I really appreciate it. Have a great day, and I will see you in the next one. And until then, keep fighting the good fight. Bye.